Great. All right. So welcome everyone to Bernstein Crypto Insights. I have with me today Richard Byworth. Richard is the CEO of Diginex. Diginex, I'll obviously let Richard introduce the group, but I think what Diginex is doing is essentially building a crypto ecosystem. I think central amongst that is a digital asset marketplace. We just thought it'll be interesting for Richard to come and talk about and introduce the group. And talk about the exchange and sort of different aspects of the exchange business today. Richard, thanks for joining us. Over to you. Why don't you probably start with by giving your background, just introducing yourself, and then we can dive into the presentation. The audience, if you have any questions, just feel free to raise your hand, and we can obviously unmute your mic and get you to ask questions. Over to you, Richard.
Thank you, Gautam. Thanks for the invitation, and thank you everyone for joining here today. It's a real honor to be speaking to clients of Bernstein, obviously the sort of institutional clients which we have built our ecosystem for. Just before I go into explaining Diginex, a little bit of background on myself. I spent my entire career in financial services. I was originally a trader in London on derivative proprietary and convertible bond proprietary trading desk. I then moved into more of an agency business where I was a market maker, and I then transitioned from London to Tokyo for the Japanese investment bank Nomura, where I actually moved into a distribution role and helped Nomura build what is today their number one position as the convertible bond house that they are. So I went out to Tokyo in 2005 to start building that desk. We very quickly took the market number one position off Goldman Sachs, and really grew it ever since from then. In 2008, we acquired Lehman. And with Lehman's arrival, it was very much like a reverse takeover. But because of the success that we'd had in building out the convertible bond business, I was actually kept in my seat. And I ended up inheriting a lot of other distribution leadership roles for derivatives, Delta One, futures and options. And in fact, when I got to the point of leaving Nomura, I was actually in the process of moving the distribution team to focus as well on private equity and secondary distribution of private equity deals. And that's what actually got me personally invested in Diginex in the first instance. I discovered Bitcoin myself after reading the book Sapiens and the modeling of societal belief systems around money. And he referenced Bitcoin many times. So I started paying attention to it. Obviously living through 2008 in a financial institution, I got very concerned with the central bank policy that we were seeing, constant printing of money. Obviously now that has just become exponential. And I'd started investing in gold, but when I discovered Bitcoin, then I started wanting to invest in the entire ecosystem. And the founder of Diginex was someone that I'd worked with previously. So when I invested, a few months later, when I left banking, he actually approached me to see if I'd be interested in helping him build what he saw as being the future of financial services around this new technology, but also creating a player that institutions would feel comfort with by focusing on being a white hat operator, only operating in jurisdictions that allow us to operate the business in a regulatory framework. And that's pretty much how we ended up with where we are with Diginex today. So with that, I'll jump into the presentation, Gautam.
Sure.
So Diginex is the first full digital asset ecosystem that comprises a crypto exchange to be listed on NASDAQ. That was a very important step for us because when we think about obviously the regulatory approach that I'd mentioned before, it's all about giving comfort to institutions so that they can start to actually move into this space, that they can have providers that are regulatory focused, but also have governance levels that are of a standard of NASDAQ, and obviously with NASDAQ Sarbanes-Oxley requirements for organizations listed on NASDAQ, there are a lot of processes and protocols that we have to have in place. And so a very different level of governance than you see at most other crypto organizations, which, you know, I can say our business since listing on NASDAQ has really started to explode in terms of institutional interest. So it really has validated that position, that viewpoint that was held by all of management. Obviously, we were recently joined by Coinbase. So Coinbase are now listed on NASDAQ as well. But we were the first, and we're very proud of that. So Diginex is a full digital asset ecosystem. Our exchange, EOS, is at the center of everything that we do. It operates out of Singapore under the MAS's Payment Services Act, under an exemption from the Monetary Authority. As well as providing spot exchange services, we do derivatives, and we offer what is referred to as a perpetual swap product around Bitcoin and Ethereum. And the next goal really is to develop that derivative ecosystem. So to be offering dated futures as well as options. But that is the main platform, and each of the ancillary businesses drive value into the exchange. I'll quickly touch on all of them, and then Gautam, if you want to focus on any particular areas while we're on this slide, then we can do that, and then I can move through the rest. So obviously the exchange, you know, we built the exchange actually after launching or sort of starting the asset management business. The asset management business, again, approaching this industry as an investor, felt very, very excited by the unique alpha that was available in crypto, and that is still available in crypto. Things that are only, you know, emerge because of the inefficiencies of having 300 different exchanges or 10,000 different cryptocurrencies and multiple different derivative styles of contract, as well as a varying degree of quality of exchange listed products as well. So all of these provide really quite unique alpha. And just to give you a guide, our fund that's been operating for 1.5 years now, the last 12 months rolling return is 98% with a sharp north of 3. So as you can imagine, we're raising a lot of capital into the fund. That sort of a profile is very compelling for the likes of family offices, external asset managers, and these sorts of players that have obviously been trying to allocate in the alternative space towards hedge funds for some time and just struggle to find meaningful returns even in that space anymore. So by building that fund, that actually allowed us to understand some of the issues that these funds were facing. So we have a fund of hedge funds that invests in various different strategies across the ecosystem. But what we noted was that there were a number of issues. Obviously, to trade the perpetual product, you'd have to trade on very dodgy exchanges, majority. And from an institutional perspective, that becomes very hard to reconcile. So these funds were struggling to raise capital because they were deemed to be uninvestable for not just that reason, but many others. And so what we've done with the fund is actually help educate people, but also we've learned what needs to be built into the exchange. So the exchange itself has been designed with many of these fund managers in mind. We have, for example, a segregation of duty function, which allows an institutional manager to have multiple different portfolio managers operating under one single account structure. That also allows us to have managed account functionality. So as an allocator to hedge funds, you can actually set up your fund within EOS and then allocate to different managers, give them access via different managed accounts, as an example. So that's how the asset management business helped inform the style and design of EOS. Touching on the rest of the businesses, custody, obviously extremely important for institutions. We focused very much on a security angle here. The security bit is by far the most important piece. If you invest in these assets and then lose them through a hack or through mismanagement or poor governance, then, you know, this is a major problem. So we built the custodian with that security framework in mind. We hired a team out of the Ministry of Defense in the United Kingdom that actually had experience in banking infrastructure and brought the tech team over from there. So that team operates as a very separate, sort of very siloed unit. We don't want anybody in the organization going near that part of the business. Everyone that works within it is very highly vetted. The solution is certified by Crest. It's accredited by Cyber Essentials. And we recently, for one particular client, have now taken down insurance as well, although the quality of the solution doesn't need insurance. It's just this particular client needed to have insurance on that. So we operate under the FCA AML-D5 framework for KYC and AML in the UK. Everything that we do is very KYC and AML compliant. We've built it all in line with FATF regulations, and obviously operating in Singapore with EQUOS. That Payment Services Act is very focused on KYC and AML as well. A couple of other aspects.
Sorry. I just wanted to kind of on this whole custody piece. This is very important because the custody infrastructure for traditional assets is very well established. So there are obviously these multiple. Coinbase has their own custody solution, so it's in-house custody solution, and then you also have other external players, Fidelity, as well as what you see with Anchorage. There's also this whole methodology of hard, cold storage and sort of hot storage of hot wallets and cold wallets. And can you just explain what it takes to kind of get that whole institutional enterprise grade custody piece? And is that sort of pretty common across these platforms that have come about?
Yeah, so it was interesting when we hired the team. Actually, the head of the team, Rob, who's the CEO of the group, and actually we give him the CEO title to just illustrate that this is an extremely separate business line. Even though it's a service provider to the exchange, it's very segregated from. So Rob, coming out of the Ministry of Defense, we sort of explained what the industry looked like and how people have gone about addressing various different custody styles. And I'll never forget the conversation with him. He was absolutely puzzled by why, the likes of Coinbase have a tent in their organization and tried to create this very unusual process around, or what they deem to be a highly secure process. And he's very puzzled. He's like, look, we've had very secure process to deal with this sort of stuff since the 70s. And we deal with it in government solutions for things like the security of the internet, things like the security of nuclear missile keys. So what he's done is he's taken a very sort of government security style approach to protecting the assets. In the cold version, so the offline solution, he actually takes the keys entirely offline, generates them through effectively a QR code that then gets taken on a printed sheet to an HSM in a cold vault, and where the keys are effectively stored. And so you have to have someone physically go down to the vault to initiate a transaction there, but it's initiated by the customer, and then they have to go to physically complete the transaction. On the warm side, those assets are online all the time. The way that we've approached it is, again, using government hardware, but more importantly, as Rob always says, no point having government hardware if you don't have government processes around it. It's effectively like just driving a Ferrari to a really bad neighborhood and leaving the keys in the car. You're going to get hacked. It doesn't matter if you don't have the processes surrounding it. So he's built perimeter technology using diodes effectively. So the majority of attacks on online wallets come through multiple different vector attacks and checks, where basically the hacker will send information in and try and find a weakness within the perimeter. So what we have is a diode effective technology. So information requests can come in, but actually, if we see that multiple people are triangulating around the assets, then we just basically send them back poor information. So we get to choose what information is going back out again. And that's how Binance was hacked in 2019. It was a similar sort of attack. So with our technology, they can't do these sorts of hacks. So Rob says to me, and said to me once he built it, he said, our warm solution is more secure than most people's cold. So a very, very solid solution approach to both online and offline, warm and cold.
Sure, go ahead.
Okay, so I'll carry on. So, obviously everything that we're doing and, with Bletchley Park, the asset manager, we've tried to design a way that an institution can come on in any way. So they want to directly touch the asset, then they can deal with the exchange and the custodian. They want to deal with allocating, first of all, to asset managers, then they can just directly invest into Bletchley Park. Another way that institutions want to be accessing it is not necessarily just through EOS. They want to maybe trade on Coinbase, Kraken, and other more legitimate exchanges as well as EOS. So with access, we built this product for our own proprietary trading desk that we had before we launched the exchange. We no longer have proprietary trading within the organization, but we built this for our traders to trade across multiple venues and have basically algorithms to trade across that, so that you could trade sort of best execution pricing or VWAP over a day, or various different algo strategies. What we did was we signed a contract with FIS, so obviously the trading technology provider, in the tail end of 2018, to effectively provide access to their institutional clients. So effectively, if they have Front Arena, that they can get this sort of multi-venue trading tool for crypto exchanges into any of those accounts. Now, FIS is a very large organization. We're in the middle of an acquisition of WorldPay, and they didn't really run with it. And the head of the product moved to Itiviti, a guy called Rob Mackay, and he said, look, FIS have done nothing with this. I want to run with it. And so effectively, he quickly got Itiviti involved, and we integrated it with Itiviti's T-Bricks. We actually launched that product in March, and we've had a lot of institutional interest. Obviously, the timing of the market, a lot of institutional interest coming through that. Banks, pension managers, asset managers, wealth managers, all starting to come through Itiviti's T-Bricks solution. So that's an EMS, OMS, and PMS solution, now able to give them access to trading crypto via EOS, as I say, Coinbase, Kraken, and some others. So the other businesses are sort of, again, more separated from all of that trading of crypto. So EOS Capital is more a longer term play on the technology that underlies all of this. There's obviously blockchain technology, and the idea that capital markets will be disrupted by blockchain technology within 5 to 10 years. So it's a longer term play. What we do with this business is we run it as a securitization advisory firm. At the moment, projects include, securitization of hard assets, LPs of private equity funds where people want to trade them in the secondary, and also direct private equity secondary distributions. So that's actually one of our oldest running businesses. We take fees in both advisory and in distribution. And longer term, this business as an originator of digital securities will then feed EOS, the exchange, as we look to list more and more digital securities on the exchange as well. And obviously a digital security that we will list will be a tokenized version of the fund, so people can trade that as a security on EOS as well, a little bit like you have in Singapore with iStocks. So a similar sort of thing as we move towards that digital security future. But as I say, that's a sort of a longer term focus. The other two businesses that I haven't mentioned are businesses that are yet to launch, both in the very final stages. So our exchange traded product business will be starting with a beta Bitcoin tracker in Germany on the Xetra exchange. That is launching towards the end of next month, and that will be distributed in Germany. But we already have quite sizable demand from Switzerland to launch a similar style product for them, because they're, that while there are a lot of these products, none of them have very clean redemption creation profiles. And a key feature of what we're doing with EQUOS investment products is actually allowing for redemption in kind. And this is really appealing to a lot of the managers in Switzerland as well. And again, you want to make sure that the ETP, or exchange traded product, that you're investing in, you want to make sure that the assets that it invests in are clean assets. And so again, by leveraging the exchange, where every single asset that comes onto the exchange is pre-checked through Chainalysis and Elliptic, that they haven't been involved in any terrorist financing or money laundering or criminal activity that we can be aware of on the blockchain, then you know that you're effectively buying clean coin, and you're buying an exchange trade product that is clean coin. Final part of the business, and I'm sure many of the people listening to this call can start to see how this all fits together. So you have your exchange, you have a very secure custodian where people feel comfort leaving their assets. The exchange is a derivative exchange as well as a spot exchange, which borrowing and lending, you need to borrow and lend assets to be able to short them. So have people have the propensity to lend them, but then that becomes like a prime services offering on the exchange. So you pull all of that together to create effectively what will be the prime services offering around digital assets. So borrowing and lending, again, launches next month with its first institutional trades. We're actually working on a fairly sizable dollar trade funded by, collateralized by Bitcoin. I don't know how many people are aware of how the borrow lend market works in this space, but it's generally driven by miners that are trying to get their hands on dollars and not sell their Bitcoin. And so there's a huge demand for dollar loans collateralized by Bitcoin. And so we're actually, one of the products that we'll launch next within the exchange traded product will be a dollar note with a very nice coupon that's fully collateralized or over collateralized by Bitcoin. The collateralization structure is generally about 150% with a liquidation, or sorry, a margin call at 120% collateralization. Obviously Bitcoin can be moved very fast. So generally if someone's going to make their margin call, they make it immediately. And if they don't, then the product goes into liquidation and the loan is settled. So that hopefully gives a full picture. Just talking about jurisdictions, the exchange operates out of Singapore under the MAS framework. DigiVault operates out of the UK under the FCA. You mentioned a couple of other solutions, Guatam. Most other institutional solutions, in fact, nearly all of them, operate out of the United States. And that is also a feature and a differentiation of DigiVault. It operates out of the UK, but also, as I mentioned, those physical vaults, we've partnered with Malcromit, which actually allows us to stand up physical vaults in any major financial jurisdiction in the world. Malcromit is a huge global vault provider. We can stand up vaults in Singapore, Hong Kong, Switzerland, wherever it might be. So physical assets can be in the nation where the investor is as well. Access, obviously, is a SaaS product, so location-wise, we're able to cover pretty much everywhere. The capital markets business operates as an authorized representative under FCA regulated entity for corporate finance and distribution of securities. Also, we're in process with the Hong Kong's SFC for Type 1 adaptation to digital, and also Dubai's DIFC Category 4 license for corporate finance. The fund operates out of Switzerland under the ARIF program there. And I mentioned that the exchange traded product operates in Germany on the Xetra exchange. And borrowing and lending at this point in time is a non-regulated business in crypto. So that's the full picture, full ecosystem. We have here a little bit of a roadmap to explain the evolution of the exchange and some of the things that are coming, what the current offering is, what the calendar Q2, which we're in obviously at the moment, and then calendar Q3 look like in terms of various rollout. You'll see that in terms of infrastructure, there's a lot happening within the derivative sort of foundational piece. So all that isolated margin, user-defined leverage, cross-asset collateralization, all of those are supporting the foundation for broader derivatives. And then you can see next quarter, we roll out options, a daily settlement, as well as dated futures. So that's when we really start to move into the full derivative offering. One point of note is the guy running the exchange traded product business is the ex-global head of structured products at UBS. And that is where we're taking that business again, longer term. Once we have strips of options, full term structure, we have obviously a place where people can be trading and hedging structured products. And that, as you know, we came from that world in traditional finance. That's the holy unity, is being able to have a structured products business with a flow derivative business. And that's where you really generate a lot of flow. So we've done it before. We're just replicating it here in the crypto space. So we obviously focus on what do we list, why do we list it. This is very important to us, is obviously making sure that we never have any assets listed on the exchange that would cause reputational risk for any institution using the exchange. And I can tell you that there's probably no other exchange that has such a rigorous diligence process around the things that get listed. So we obviously focus on the core value of trust, fairness, and innovation. It's very, very important to us that these projects are not effectively any risk of being hacked. So take, for example, any proof of work project that has to be 51% can create changes in the network. You take Ethereum, Ethereum Trust, the ETC project, Ethereum Classic, that's listed on many exchanges. Last year, that was hacked 4 times through a 51% attack. And many people go on Coinbase and these other places and they accidentally buy Ethereum Classic thinking they're buying Ethereum. And so it's, for us, this is not protection of your users. And I always say that we want to be able to let your granddad go on this exchange and not be worried that he's going to end up buying some project that's a complete scam or not secure in any way. So we look at all these various different components. I'd say that on the innovation side, actually the last point there, ongoing improvements to the network, is another really important thing. A lot of people look at Litecoin. I think it's still in the top 10 cryptocurrencies. It has not had any developer input for nearly 12 months now. That is a dead protocol.
Yeah, I call it a free riding protocol by calling it the silver Bitcoin. I mean, Bitcoin is digital gold. Litecoin was kind of positioned itself as a digital silver. And that has stayed for so long with no development activity. You're absolutely right. I mean, I've always felt that.
Yeah. So, look, we get a lot of market makers and traders say, look, we want Litecoin.
Well, so exchange good, so people like the volume on Litecoin, and that's why exchanges have it.
Exactly. We get pressure all the time. Please list Litecoin. We're trading a lot in Litecoin. We're not listing Litecoin. It's a dead project. It's dead. I mean, sure, we could do a lot of volume in it, but it's a dead protocol. And this is the whole point. We want to make sure that there's integrity of the things that get listed on the platform. So here, this was a suggestion of Gautam, just to understand a little bit the pricing landscape of how different exchanges price things, where they operate from, whether or not they have a utility token. So you can see the fee ranges there. Coinbase obviously charging very, very high fees. Fantastic for Coinbase, that a lot of people use them. But what's interesting is that high frequency traders certainly don't want to go anywhere near Coinbase. If they're trading on Coinbase, they know that they're creating effective negative selection through just the fees that they're paying to do those transactions. The fact that anyone would trade with them is problematic. So, then you've got the other end of the spectrum is the sort of the Binances, the Deribit, and the FTXs operating out of, jurisdictions that are not necessarily, credible jurisdictions from a regulatory perspective. But still they're doing huge volumes. And Deribit is pretty much the only credible exchange, I would say credible, the only exchange that are trading any options of any size. So, we look forward, and we have many clients that say we're very much looking forward to you guys launching options so that we don't have to use Deribit so much.
Hey, Richard, here I just wanted to kind of bring in the whole point around liquidity and volumes, right? So last I checked, the top 4 exchanges, Binance, FTX, Huobi, and OKX, did about $187 billion volume a day. Yeah, I mean, obviously there's, talk about it's particularly OKX and Huobi, with the kind of wash trading and those kind of acquisitions. But more interestingly, I think the fact that they have this capability to do the high frequency API trading, which I think Binance and FTX have built, and most of the high frequency traders like that. How do you kind of position from a volume perspective? Given that that's what sort of the market makers and all of that. For anyone to come and trade on a platform, you need the liquidity and the market making.
Yeah, look, I'm pleased to say that our volumes have finally got to meaningful levels. We did have an experience probably, 7 or 8 weeks ago, where we just onboarded a new market maker, and Friday night, suddenly our volumes spiked, and we did like $50 million in the space of an hour. And I called the exchange team. I said, what's going on? And they said that they'd worked out that this market maker had come on and just started match trading with themselves. So it was just like trading with themselves. It was like, so we called them and we're like, what are you doing? And they said, we thought this is what you wanted. You wanted your volumes to be high, right? And we're like, well, yeah, but this is not real volume, and you're on a 0 fee basis, so there's no benefit to anyone from this. And they said, well, this is what we do on unnamed other exchange, and we thought that's what you wanted. And so we said, no, that's not what we want. And so yeah, they still trade on the exchange, but it's obviously nowhere near the quantum of $50 million a day. It's real business. Look, we listed on October 1st. We were doing anywhere between $1 and $3 million of volume per day. Obviously, that is not interesting for someone who's looking at liquidity in the market. So I'm pleased to share that we crossed $100 million in daily volume recently, and we've got a very close partnership with GSR, which is probably the biggest market maker in crypto. And they said they've never seen an exchange that's doing real volume scale as fast as we have. So clearly, we're doing a few things right, and we're attracting institutional real business. I'll make another point about liquidity. We recently had a venture firm come on looking to buy fairly decent size of Bitcoin every day. And we were obviously, because we were still back then, we were doing about $50 to $60 million per day. And we were just a bit concerned that they wouldn't end up with the best execution if they were transacting on our exchange. So what we did is we looked at Binance, that obviously you mentioned, they're probably the biggest out of those top 4, doing nearly $100 billion a day themselves. We compared our Bitcoin order book to their Bitcoin order book. And what was very interesting was, even though they're obviously doing huge volumes, actually the depth of the book and the amount of the book you had to go through to get the amount of Bitcoin that they were trying to buy, actually our book was more competitive than their book at that particular time, which was great because we were going to actually direct the flow towards Binance if it meant that the client was going to get a worse execution. Yeah, look, I think the liquidity in this space is interesting. We've learned a lot as we've progressed through it, that around the liquidity not really being necessarily what it's set out to be, but it is obviously still a very liquid market. I would say that real trading, you've still got, I mean, $20 billion of crypto volume going through the market a day, and 3 times that amount going through in derivative product. So, obviously, we make the point that Coinbase, obviously the big elephant in the market, but they don't do derivatives, and so they're missing out on potentially
My
meteoric.
guess is, do you do derivatives in the US? Because there are obviously specific regulations which prohibit offering derivatives to US citizens.
No, we absolutely do not, and in fact,
Yeah.
a few of our competitors have run into issues because they have allowed US residents or US persons to onboard and trade derivatives. The CFTC has a very long arm and is even very focused on US Nexus. So, for example, if we had a Cayman funds structure that was basically operated out of the US and tried to onboard, we wouldn't be able to onboard that fund because the CFTC would say, no, that's effectively a US nexus. Everybody's on board, onshore in the US. And so we wouldn't onboard a fund like that.
And the other question I had was about this whole fees, on spot fees particularly, and this big divergence between Coinbase and others. It's not just these exchanges which you put in. So Binance has a Binance US entity, FTX has an FTX US entity. They have aggressive plans, and they've come up with very attractive, very sort of similar level of pricing in the US market. How do you think this whole divergence between Coinbase pricing and the US exchange price, US units of these exchanges, how does that dynamic work out?
I would say that, yeah, Coinbase's margins are getting squeezed. There's no question. The retail market have multiple different choices. And as you say, FTX and Binance are now already onshore in the US with their lower fee structures. I would say that Coinbase just, they have made very good, significant traction with institutions. And when I say institutions, I mean obviously the institutions like some of the people that you have on your call. These are also the institutions that we're focused on. And I think that when you think about liquidity and depth from that perspective, Coinbase as well on the fee side, they're not charging these institutions, 50 basis points. So it is as that business will shift and they lose more of their retail customers, their margins are going to be compressed, no question.
Sure. Go ahead, Richard, with the rest of it.
Sure. So another thing that I think you'd mentioned was an interesting thing for people to understand.
Yeah. Very interesting, right? Given the success of exchange tokens that has played out. So just for context for the audience, BNB and FTX, BNB is the Binance token and FTX is the FTX token. Both these leading exchanges have had a very strong bootstrapping strategy with incentivizing users, and Richard will talk about it, but incentivizing users and incentivizing volumes and giving fee discounts linked to the tokens. And then these tokens have almost become like participants in the ecosystem. So if you're a token holder, you are eligible for new tokens that get listed on these exchanges, or new tokens are distributed almost like new exchange offerings of new tokens. And if you're a Binance coin holder or a FTX coin FTT holder, you get sort of special access to either purchase those tokens or participate in those pools. So it's been one of the central pillars of growing that business for Binance and FTX, and even other exchanges have followed. As of today, Binance probably BNB tokens market cap is what, $90 billion, more than Coinbase. But obviously, this is obviously part of their view to kind of expand beyond the Binance exchange into sort of the Binance Smart Chain and FTX with the Solana blockchain as well. So a lot of valuation has kind of come from there. So just from an audience, so I wanted Richard to talk about his token, and then how does it kind of compare with other tokens?
Yeah, so we put together this just sort of quick and easy way of looking at the token. And we launched our Equo token on the 8th of April. It's quite different actually to the way that other tokens operate. You can only earn it. There was never any sale.
Sure.
And you earn it via trading, and you earn it via staking. So if you got on early and traded aggressively, you would have earned a significant amount of the token. And actually, for the period that not many tokens had been issued, you were also earning massive staking rewards. So for the first 2 weeks, the annualized staking rewards were like 350% on the token. So we obviously wanted to incentivize people to come on the exchange early, and this obviously had been involved in tripling the volumes on the exchange as well. It's had a lot of take up. We're seeing the most amount of customer sign up we've ever had on the retail side. It's really got us a lot of traction, and it's smart. I mean, Binance and FTX both, actually all of these guys have used the token much the same way that we are, in terms of effectively front loading your revenues, so that you pay out some of those revenues effectively, or sort of be more generous in accepting lower revenues, but the token allows you to bring them forward. And so it's effectively sharing the value of your ecosystem with the early adopters. So, I actually, the call before this, I was just with the CIO of one of the largest hedge funds in the world, him getting his head around the Equo token and just saying, look, this thing can only go up. And you're like, yeah, this is the point.
The comps are so rich here, right? FTX at that market cap and Binance at that market cap. So everything in value, every valuation of tokens is all around comps, right? So he's right.
Yeah, I mean, look, you just mentioned Binance is a 90 billion market cap on their token. Ours is a 10 million market cap. That's fully diluted. So, it takes 2 years to earn the entire issuance of EQUOS. So it's a 2-year issuance program. And over that 2 years, it will, at the current price, it will be a $10 million market cap. There will only ever be 21 million tokens, and it's trading at about 50 cents at the moment.
What I find about tokens is the whole marketing push that one can do, right? Like, you can, instead of giving cash rewards, you are actually then giving out your tokens, which are part of your unissued treasury, and then parts,
So yeah, it effectively becomes a currency for the exchange.
Participants are kind of owning that as part of providing.
Sorry, I missed that last bit. You broke up for me a little bit there, Gautam.
No, it's fine. I was just talking about how. Can you hear me?
Yeah, I don't know if you've got a slightly unstable connection, actually.
Yeah, I'm just checking. I think it's fine now. But I think I was just making the point that the whole marketing push that one gets from the tokens is the most interesting piece, right? Instead of giving dollars, you're giving them tokens, and that's how participants who contribute to your ecosystem earn tokens, and that's the most. That's the part I find most fascinating.
Yeah, we actually, looking back on the way we did it, actually, by not doing a sale, we effectively didn't garner so much community. But actually now, because people are starting to find out about it, they're saying, how do I get this token? It's creating a lot of community. But we do allocate part of the daily allocation to our treasury. So we take 10% of the daily allocation to our own treasury for that exact reason, so that we can use it to incentivize, influencers, market making, whatever it might be on the exchange. What's interesting about the token is because, we've designed it with some really cool features within it. As you can see, it's got all these various different things: proof of trade, staking, fee reduction, yield enhancing, buyback and burn, as well as cross-collateral functionality and airdrop access. Because of all those different features, actually a lot of the market makers on the platform that were on very preferential fee rates, and so therefore excluded from receiving Equo, have actually asked to move to higher fee tiers so that they can earn Equo every day. So it's very interesting how it's creating incentives on the exchange for the traders. So I will, unless you had any particular other questions around the token, I'll keep moving.
Sure. Yeah, keep moving. Yeah.
So we're actually the first NASDAQ listed company to issue a utility token. I'll just explain. So basically we have a daily reward block. We call it the daily reward block. 85% of that goes to traders on the platform paying taker fees. But the other 15% goes to staking rewards. If you're holding the token, you get more token every single day. And over the course of time, we do halvings. So the issuance on a daily today is about 105,000 tokens. And in 90 blocks, so 90 blocks from the beginning, so 90 effective days, we halve the supply. And at every halving, the reward ratio splits from goes 10% in the other direction. So at the next halving, staking will increase to 25% of the reward, trading will drop to 75% of the reward. So you're effectively you're very incentivized to get the token at the beginning. And obviously, as people start to understand that, they want it more and more, they end up onboarding and they end up trading, which is exactly obviously what we want to try and achieve. Cross-collateralization, as we roll out cross-collateral on the exchange and derivative product, Equo can be used within as an asset to collateralize trades, loans, etc. On the yield side, as we roll out borrowing and lending, if you hold Equo to certain levels, you get higher interest rates on the coins that you're earning interest on, and you get lower fees. So fiat tier upgrades as well, the more of the token you own. Additional feature around utility is the airdrop functionality. I think you mentioned that in terms of preferential for any other tokens that get issued within the ecosystem, to have that sort of first airdrop. It gives the original supporters of the token, that's why we call it EQUOS Origin, i.e. it's the origin of everything around the exchange. You just get more airdrops of these new utility tokens that come to the fore as we grow out the ecosystem and incentivize value across it.
Sure. Richard, we're just probably 10 minutes to the hour. So just wanted to see if the audience has any question. Raise your hand. Yeah. We can obviously take questions right away. Continue, Richard. I just wanted to say that. Yeah.
So yeah, look, I'll be quick because we obviously have dwelled on a few slides. What we wanted to do is just spend a little bit of time sort of illustrating how people can invest into crypto broadly, what the various different offerings are for an institution. So obviously there's directly into the asset. So for that, you would need your own custodian. In fact, I'll just go through each slide. So directly in the asset, you can either through us, you can access it through our OTC desk or through our exchange. The OTC does direct to Digivault custody. The exchange, obviously you would be using Digivault custody, but obviously the OTC desk is more a sort of a white glove approach. You call someone up, buy Bitcoin, sell Bitcoin, whereas EQUOS, you go on and you're trading it yourself. We've talked about derivatives briefly. Obviously, derivatives are a very interesting way for institutions to play this space. You know, call overwriting, put underwriting, these sorts of things as these products develop are extremely important. The most common product is the perpetual future. So that's a never expiring future that trades 24/7. A lot of institutions start with the CME futures contract, but quickly work out that it's 9 a.m. to 5 p.m. US hours, and this is an asset that trades 24/7 and can tend to have very volatile weekends. So as institutions sort of get to an understanding of the asset class, they want more and more to be able to access places where they can trade 24/7. And so obviously these perpetual futures are the product that the majority of people end up using. You can take some fairly heavy leverage. We do allow leverage up to very high levels, but only for very small trades. So we manage the whole risk curve very carefully with the liquidation profile. But if you want to do a meaningful size position, you probably should be looking at about 5 to 10 times levered as a maximum. So the funds space is obviously very interesting. There's venture capital, there's directional. We've obviously focused with Bletchley Park in our fund of fund on that hedge fund space. So the very unique alpha opportunities that I mentioned before, but venture is huge. I would say that in the asset management space, it's not kept up with pretty much everything else, but it's probably still around 10 to $15 billion actively managed, the large proportion of that being in the venture space. Big names are Polychain Capital and Pantera. And then obviously directional, it's same as directly holding the assets, but there are, many funds that sort of put structures together to hold indexes or other types of things.
Hey, Richard, there's an audience question which I wanted to take, which is mentioned. So, there's always this question about central governments banning digital assets. We hear, different governments talk about banning digital assets, and obviously you end up serving some of those jurisdictions. How does it play out, right? I mean, how does it impact your business? How does it impact? I mean, how should investors think about these risks?
I think it's a really interesting question because we've seen some of these U-turns play out in real time last year. So Nigeria was quite interesting. Sort of their Congress discussed Bitcoin quite openly, and there were some videoed discussions that were had. Basically, they decided to ban it and then realized that they couldn't ban it, and did a U-turn on it. Which was very, very interesting. Turkey have obviously banned it as the lira has struggled, and I think that you've seen a massive spike in the amount of demand for Turkish people to be buying crypto as a result. I think the cat's out of the bag somewhat with governments wanting to protect or sort of keep people enclosed in their fiat currencies, certainly capital controlled nations. And so more and more people understand what the asset can give them. There are many local peer-to-peer networks that are very, very active on the ground in places like Venezuela and Turkey and other places that have banned Bitcoin. If a country that we operate within were to ban crypto, we'd obviously have to make sure that we were very careful around offering to clients of those countries. We probably would have to suspend accounts, but we don't have any clients in Turkey or India at this point in time. I don't know why I mentioned India. Sorry, they were in my mind. India is another interesting one.
Yeah, India.
So India had. India had previously banned crypto, but then the regulator turned around and said that's unconstitutional. And
I mean, the Supreme Court. I think they went to the Supreme Court where they overturned the ban by the central bank.
Yeah, it was the Supreme Court turned around and said this is not unconstitutional. Then obviously what was interesting was, if you think about India looks at Singapore, India looks at the US in terms of innovation. Obviously both those regulators very accommodative. But I would say probably more importantly was Pakistan's announcement that they're going to start mining Bitcoin, that India probably thought again about really restricting innovation within their country, because they're obviously directly competing with Pakistan. So I think
Sure.
I think India will be one which they won't ban it anymore. I think that's finished.
Sure.
But yeah. So shall I continue, Gautam, or do you have other questions?
Yeah, continue. Yeah, no, I think it's
great. So here we just talk about the investment products. Obviously, Equus, is having its own investment product launching. The Grayscale product, I'm sure many of the investors on this call are aware of the limitations of the redemption profile of that fund, which has led to it trading at significant discounts. Now that
just talk about this redemption feature in like what makes them a non-redeemable versus what you are trying to do.
So they don't offer redemptions. You can't redeem that fund once you've effectively created more of the fund, then there are no redemptions allowed. So effectively the amount of Bitcoin within Grayscale should never change, but the NAV that it can trade at could end up being quite a significant discount, which we've seen, obviously, because people can't get their money out. And you've got more flexible solutions coming to market, like the ETFs that we've seen issued in Canada, have meant that people have really flocked out of Grayscale into the ETF products that have been launching. I think also being able to have physically delivered redemptions is quite a key feature for many of the institutions that have looked at what's happened in the gold swap market and synthetic ETFs previously, and want to hold physical ETFs. Physical ETFs that are backed by real Bitcoin. So obviously that's a feature that we allow.
Got it.
So we also talk about the miners. Miners is obviously a very different business. It's very much an efficiency business, making sure that you're using the cheapest electricity, the best infrastructure, the best machines, tweaked to the best levels, hopefully in a very cold jurisdiction. It's a very competitive business, actually. And if you're not competitive, you quickly go out of business. So actually, it's interesting to have listed vehicles because they are able to raise capital and keep being very competitive. And that's very important. Like, these companies will always be needing new financing. So I think that's is an interesting business. It's a business we were involved with. I can tell you, we sold that business, and I'm very pleased we sold that business. Highly, highly competitive, very painful business, but yeah, not obviously something as financial services guys we're particularly adept at. But we did sell that business at the right time, at the top of the bull market. So we were happy about that. And then finally is just the ecosystem trades that are listed. And obviously we're one of them. Coinbase is, a much bigger version of us. I think that, with the amount of growth that we're seeing and having that derivative flexibility, the fact that the derivative market will continue to grow. I mean, you look at FX and interest rate derivative markets, they're hundreds of times the spot market. Right now, crypto, even though it's large, it's still only 3 times the spot market. It's still very nascent. And so, we're not only at an explosive point in our growth cycle, but we're sitting on the most explosive growth product in terms of our focus. So very excited to have been able to present all of the ecosystem to you, and thank you for listening.
Great, Richard. I think that was fantastic. I think very comprehensive. I'm gonna probably sort of close it out if there are not any more questions. But Richard, pleasure. I think fascinating. I think you're bringing the best of both worlds. I think some good practices from Binance and FTX, and then obviously making it in a more institutional context. So I think that's very interesting.
Fantastic. Well, look, thank you again, Gautam. Really appreciate you and the team's support. So it's been enjoyable, and thank you again.
Great. Thanks, Richard. Look forward. Bye.
Bye-bye.